Hello, I'm George Rodriguez, a senior business manager in Latin America and founder of kPaGold, a consultancy focused on helping SMEs grow with financial discipline and international strategy. When an SME owner tells me they want to go international, I always ask two questions. Do you already have a customer out there? Do you have a financing structure ready to support that growth? Almost always the answer to the first is we're looking, and the answer to the second is an awkward silence. The most recent data shows the concern is justified. The OECD SME Financing Scoreboard 2026, which tracks 48 countries, shows that although there are signs of recovery, financing conditions for SMEs remain tight. Borrowing costs are still above pre-pandemic levels. In most countries, the volume of new loans grew by only 5.7% in 2024 and remains below the 2022 level, and the stock of credit to SMEs has barely moved. At the same time, the world expects these same SMEs to invest in productivity, digitalization, sustainability, and international expansion. It's like asking someone to run a marathon while cutting off half the water stations along the route. As a senior director looking at the reality of Latin American SMEs, I see three uncomfortable truths. If you try to go international with only your existing working capital and overdraft lines, cash won't hold. If your basic numbers aren't well organized, management income statement, cash flow, margin indicators, new financiers simply won't approve you. If you ignore the new solutions, fintechs, digital trade finance, export guarantees, hybrid instruments, you'll conclude that there's no money, when in fact it's simply somewhere else. Let's organize this thinking into 4 blocks. What the global SME financing landscape looks like in 2026, which structures make sense for financing internationalization. How to prepare the SME to be financeable, the pros and cons of this new financing architecture. 1. The global SME financing landscape in 2026. The 2026 scoreboard shows that after a phase of high interest rates and uncertainty, conditions are still far from returning to normal. Some key points. In 34 of the 39 countries analyzed, the cost of financing for SMEs remains above pre-pandemic levels. The stock of SME credit is practically stagnant, and the growth seen in 2024 has not yet offset the earlier drop. New loans remain below 2022 levels. Long-term loans have declined, which hampers larger investment projects, exactly what internationalization demands. In addition, complementary reports show that banks in many countries have grown more cautious about default, which translates into stricter terms, more collateral, and more demanding documentation. In short, traditional credit has become more expensive, more selective, and shorter term. 2. Structures that make sense for financing internationalization. The good news is that the same scoreboard highlights a move toward diversification of sources and instruments. Instead of relying only on classic bank loans, companies that want to go international have other levers. A. Trade finance and export-linked financing. Studies show the cross-border trade finance market for SMEs is expected to grow from just over $52 billion in 2024 to almost $94 billion by 2032, driven by digital platforms and new risk assessment models. In practice, this means advances on export contracts and firm orders, where the bank finances production and the collection period. Letters of credit, guarantees, and export credit insurance, which reduce the buyer's risk for the bank and unlock limits. Specific products from export credit agencies and public banks aimed at supporting companies that sell abroad. B. Development bank lines and public programs. Many countries have development bank lines and promotion agencies focused on innovation, sustainability, and internationalization, often with terms and costs better suited to the type of project. These lines can finance investments in productive capacity and regulatory adjustments needed to export, digitalization projects and system integration to operate abroad, trade missions, fairs, prospecting, and channel development in other countries. C. Fintechs and non-bank financiers. The scoreboard and related analyses show that fintechs and non-bank players are gaining ground, especially in countries with significant credit gaps. In many cases, they offer credit based on sales data, online revenue, receivables, and account turnover with faster processes. Invoice finance, structured advances on invoices, and revenue-based finance, variable repayments tied to revenue. Integrated platforms for trade finance and credit insurance for SMEs with smaller tickets and simpler processes. D. Hybrid instruments, venture debt, equity, and partnerships. For more innovative SMEs or those with a strong technology component, instruments such as venture debt and venture capital increasingly appear in reports as part of the growth financing mix. In some countries, governments are expanding public or hybrid funds to support these structures, focusing on green tech, deep tech, and high-growth businesses. The central point: going international today requires a smart combination of instruments rather than putting all the capital pressure on a single bank line. 3. How to prepare the SME to be financeable. This part is critical, and many companies underestimate it. Reports on SME credit show that the shift to more data-driven models makes businesses with good financial governance far more eligible for financing than those operating in the dark. In practical terms, you need to organize your management income statement and cash flow with a consistent history and reasonable projections, something many lenders and fintechs already use as a basis for credit. Clearly separate company and personal finances, avoiding the mixing of expenses and revenues that undermines risk analysis. Document key contracts, firm orders, pipeline, and customer portfolio to prove the revenue base that will support internationalization financing. Ensure minimum governance, internal controls, basic processes, compliance, especially if you want to access public lines and more sophisticated trade finance structures. In other words, the more professional your financial management, the more financing doors open. 4. Pros and cons of this new financing architecture. On the positive side, you stop being captive to a single bank and a single line, reducing the risk that a lack of credit makes your expansion unviable. You can better align financing terms with your cash generation cycle. For example, using export-linked trade finance instead of consuming generic working capital. You gain access to sources that better understand accelerated growth, innovation, and internationalization, such as development banks, funds, and fintechs. On the negative side, financial management becomes more complex. You coordinate multiple instruments, each with different costs, guarantees, and covenants. It demands a stronger culture of transparency and data discipline. Creditors want to see numbers, not just narratives. Your average cost of capital can rise if you don't combine structures well. For example, using only expensive short-term credit to finance long-term projects. As a senior manager, my advice is this: internationalization in 2026 is a game of commercial strategy plus financing architecture plus management discipline. None of the three can walk alone. I'm Jorge Rodriguez, a senior business manager in Latin America, and at kPaGold we work precisely at the intersection of these three fronts: market design, financing structuring, and the implementation of financial management that makes the plan fit within cash.